Everyone has bank accounts, but do you have the right bank accounts that you use for the right purposes? There's a way to optimize your bank account setup, including what accounts you have, like checking accounts, saving accounts, and investment accounts, and how you use those different accounts within your overall banking system. In this video, we're going to cover all of those different account types, including how to use them, when to use them, the coverage you have with them, and just everything that you need to know about them. This is basically going to be your guide to bank accounts that puts everything together for you all in one place. We're also excited to say that we're working with CDIC on this video. Now, if you haven't heard of CDIC before, it stands for the Canada Deposit Insurance Corporation. And we're going to be talking about how CDIC helps protect your deposits in all the different accounts that we're talking about throughout the video. So let's jump into it. The first bank account is the checking account. This is typically the first account that everyone gets, and it's used as the main account for daily banking because you can use it to deposit your income into, you can withdraw money out of it, you can pay your bills from it, basically all the ins and outs that you have on a consistent basis with your money. Now, we like to think of checking accounts as money hubs. It's like a transactional spot that just constantly has money flowing in and flowing out. Now, checking accounts are an essential starting point for your bank account setup because you need an account that allows for all this different money movement to happen. But beyond being used as a money hub, you don't need to or necessarily even want to keep too much money inside of your checking account. The main reason for this is because checking accounts typically don't earn any interest. So your money is just sitting there doing nothing for you at all other than letting you take it out easily. Now, you do need to keep enough money in your checking account to pay for all your expenses throughout the month, right? So that could be the expenses that are automatically taken out of your checking account. Think things like rent, hydro, internet, what else? Your car payment, bills, anything like that, and also enough to pay off your credit cards throughout the month too. Now, something that's really important to mention is that because the checking account is likely the first bank account that you ever opened, you probably didn't put a lot of thought into where you were opening up your checking account or what features of the checking account that you opened up had. But it's a misconception that all checking accounts are the same. Some actually charge you a fee just for simply opening up and having a checking account, and then other ones require you to have a minimum balance in order to waive that fee. But there is no fee checking accounts that exist too, and there's even hybrid saving and checking accounts that exist now as well. So it's important to do your research and pick a checking account that has all the different features like you need, like the ability to deposit money, send e-transfers, maybe take cash out from an ATM, maybe write checks, but also charges you the lowest amount of fees possible. Now, the last thing that we want to touch on when it comes to checking accounts is the protection that your money has that you keep inside of your checking account. Like I mentioned earlier, we're working with CDIC on this video. Now, CDIC is a federal crown corporation that was created by Parliament in 1967 to ensure eligible bank deposits up to $100,000 per category that are held at any of their member Canadian financial institutions or federally regulated credit unions. Now, you'll notice that I said per category. CDIC specifically covers 9 different categories, including deposits held in one name and deposits held in more than one name, so joint accounts. These categories cover money that you have in checking accounts, savings accounts, GICs, and other term deposits. So any money that you have in a checking account is covered by CDIC up to $100,000, and that $100,000 is spread across other deposits held in one name too. You also have another $100,000 worth of coverage from CDIC for money held in a joint checking account too. And again, that $100,000 worth of coverage is spread across other deposits that you have held in more than one name too. What's great about CDIC's coverage is that it's free and automatic, so you don't have to sign up on your own as long as you bank with one of their member institutions. That means that if they ever were to fail, you wouldn't lose your money. And you can see if your financial institution is a CDIC member on their website.
The next bank account is a savings account. Now, savings accounts are typically used to hold money that's going to be used for a specific purpose in the future. This could be for short-term savings for things like vacations, gifts, car repairs, or it could even be for longer-term savings like saving for a down payment for a house. The reason you'd want to have at least some money in your savings account is for your emergency fund. Now, an emergency fund is exactly what it sounds like. It's a fund of money that you can use in an emergency. An emergency could be you getting into a car accident and having to pay for damages. It could be you having an urgent medical expense come up that you didn't plan for, or it could be you losing your job and not having any income coming in. Basically, any unexpected cost that you wouldn't be able to pay for out of your regular monthly budget and income. Now, because emergencies usually involve urgent expenses, you'll want to have some money set aside in accessible cash. Basically meaning that it's just not invested, so that you can withdraw it and use it if and when you need it. We like to say that you should keep at least 3 to 6 months worth of necessary expenses in an emergency fund. So if you spend $2,000 a month on your necessary expenses like rent and food, then you'd want to have $6,000 to $12,000 in your emergency fund. That also means that in a worst case scenario where you lost your job and didn't find a new one for 6 months, you'd still be able to cover your day-to-day expenses. Now, ideally, you'd keep your emergency fund and really any savings that you have in a high interest savings account. A high interest savings account is a savings account that earns more interest than a traditional savings account. Interest rates are always fluctuating, but make sure you do your research to see what's currently considered a high interest rate. The main reason why earning interest on your savings account is important is because you plan on having that money sit there for at least some period of time. It's not like a checking account where it's expected that money is going to be coming in and out all the time. So you at least want to be keeping up with inflation. Now, inflation is the cost of goods and services going up over time. Before 2020, a standard rate of inflation was about 1% to 2% per year, and more recently, it's been higher than that. So you want your savings account interest rate to at least match the inflation rate. Now let's talk about CDIC savings account coverage. It's actually the exact same as checking accounts because savings accounts also fall under deposits held in one name and deposits held in more than one name, so joint accounts. These two categories cover money that you have in a checking account, savings account, GICs, and other term deposits. So any money that you hold in a savings account is covered by CDIC up to $100,000, and that $100,000 is spread across other deposits held in one name too. You also have an additional $100,000 worth of coverage from CDIC for money held in a joint savings account too. And again, that $100,000 is spread across other deposits held by the same set of joint owners too.
The next bank account actually isn't a bank account, it's an investment account. Investment accounts are accounts that don't just let you put money inside of the account, they also let you purchase investments with that money that you put inside the account. Now, there's a few different reasons why you might invest your money. It could be for retirement, it could be to buy a house, or it could be for you or your children's education. There's also two different investment account categories: registered or tax-advantaged investment accounts and non-registered or taxable investment accounts. Now from there's also a few different types of registered investment accounts, but all of them have tax advantages, which are basically just tax benefits that differ depending on the specific type of registered account. All registered investment accounts are literally registered with the government. Now the government created these accounts to incentivize people to save for all those different purposes that we mentioned before. So either for retirement, to buy a house, or for education. All of the different registered investment accounts also have a cap or a maximum amount of money that you can put into the account, which is called the contribution limit. Now if you invest the money that's inside of this account, then your money can grow past that limit, but you yourself can only contribute up to that specific limit. Now, because of the tax benefits, you'd probably want to use a registered investment account before you use a non-registered investment account. But you could get to the point where you've maxed out, meaning that you contributed that max amount of money to your registered investment accounts, and at that point, you might want to consider also using a non-registered investment account too. Now, in Canada specifically, there's 6 different types of registered investment accounts that we want to cover. There's the Registered Retirement Savings Plan, or RRSP, the Registered Retirement Income Fund, or RRIF, there's the Tax-Free Savings Account, or TFSA, the Registered Disability Savings Plan, or RDSP, the Registered Education Savings Plan, or RESP, and then the First Home Savings Account, or FHSA. Now, the first 4 types of registered investment accounts, so the RRSP, RRIF, TFSA, and RDSP, can all be used to save for retirement. The RRSP was created for this purpose. Now, this account is tax deferred, meaning that you don't have to pay taxes on the money you contribute to your RRSP until you withdraw from it in the future, and you can also use it to reduce your taxable income in the year that you contribute money to your account. Now, if we go back and look at the 9 different categories that CDIC covers, deposits held in an RRSP is one of them, which means that deposits held in an RRSP have $100,000 worth of coverage that's separate from any of the other categories. Now, one thing that's important to mention when it comes to CDIC's protection of the different investment accounts is that CDIC specifically covers the following eligible deposits held within an RRSP: Canadian or foreign currencies, GICs, or other term deposits. If you hold mutual funds, stocks and bonds, ETFs, or crypto in your RRSP, those products aren't covered because they're not guaranteed.
The RRIF is basically an extension of the RRSP. Once you reach a certain age, so 71, you have to convert your RRSP into an RRIF. The RRIF is the account that allows you to take income for retirement. Once your RRSP is converted to an RRIF, there's a set minimum amount of money that must be paid to you or drawn from each year. You can't just have your money sit in an RRIF forever. Instead, it's slowly paid out to you in set increments, and you also have the option to withdraw more money if you want to. Now, just like the RRSP, the RRIF is one of the 9 categories that CDIC covers. So deposits held in an RRIF have $100,000 worth of coverage that's separate from any of the other categories, and only eligible deposits are covered. One thing that's important to mention is that there are different types of RRIFs. There's LIFs, there's LRIFs, there's RLIFs, there's PRIFs. CDIC provides coverage for all of these different RRIFs RRIF types, but keep in mind that the $100,000 in coverage would be for a combination of all these types. So if you have $50,000 in an RRIF and $50,000 in an LRIF, all of your money would be protected. But if you had $100,000 in an RRIF and $50,000 in an LRIF, only $100,000 total would be protected. The TFSA is another registered investment account that you can technically use for any purpose, but it's great to use for retirement savings. The TFSA is tax-free, meaning that the money that you contribute to this account can grow tax-free. And when you withdraw money from your TFSA, you don't have to pay any taxes, which is a great perk. So deposits held in a TFSA have $100,000 worth of coverage that's separate from any of the other deposits, and only eligible deposits are covered. The last registered investment account that can be used to save for retirement is the RDSP. You're only eligible to open an RDSP if you qualify for the disability tax credit. If you do, then definitely look into opening an RDSP because there's a lot of government grants and bonds that you might be eligible for. The RDSP is also one of the 9 categories that CDIC covers. So deposits held in an RDSP have $100,000 worth of coverage that's separate from any of the other categories, and only eligible deposits are covered. One thing that's important to mention is that CDIC's $100,000 worth of coverage for eligible deposits held in an RDSP is per beneficiary at each CDIC member institution. So if you have 2 beneficiaries of your RDSP, you could have 2 RDSPs with the same financial institution, both with up to $100,000 in them, and they would both be covered.
The other 2 types of registered investment accounts are the RESP and FHSA. The RESP can be used to save for your or your children's education. Now, as long as you use the money inside of an RESP towards qualifying education expenses, then you can withdraw the money tax-free, which is great. Beyond that, just like with the RDSP, you might be eligible for different grants and bonds within an RESP too, so it's a great account to open if you're going to be saving up for education expenses. The RESP is another one of the 9 categories that CDIC covers. So deposits held in an RESP have $100,000 worth of coverage that's separate from any of the other categories, and only eligible deposits are covered. But just like with the RDSP, CDIC's $100,000 worth of coverage for eligible deposits held inside of an RESP is actually per beneficiary at each CDIC member institution. So if you have 2 beneficiaries of an RESP, you could have 2 RESPs at the same financial institution, both with $100,000 in them, and they would both be covered. Now, the FHSA can be used to save for your first home purchase. It's specifically for first-time home buyers, which means that in the current or last 4 calendar years, you haven't lived in a qualifying home that you owned. The FHSA has a few different tax benefits. As long as you're using the money to purchase a qualifying home, then you can withdraw money from the account tax-free. And when you contribute money to the account, you can use it to reduce your taxable income. The FHSA is another one of the 9 categories that CDIC covers. So deposits held in an FHSA have $100,000 worth of coverage that's separate from any of the other categories, and only eligible deposits are covered. The final category CDIC covers is deposits held in trust. Now, if you're interested in hearing more about trusts or any of the registered investment accounts that we just covered, make sure you check out this playlist after this for more information.
So those are all the different bank accounts or money accounts in general that you might have. For most people, you'll start with a checking account, hopefully a no-fee one, and a savings account, hopefully a high-interest one. Then once you're ready to start investing, you'll open one registered investment account at a time, depending on the reason why you're investing. For most people, that would include the TFSA or RRSP for retirement and the FHSA for your first home. In general, we want your money system to really work together. Your checking account is your money hub, with money flowing in and out throughout the month. Your main savings account is your emergency fund. That, once you've built it up, just sits there. And your investment account should be growing every month as you add money into them. If you want to hear more about our personal money system and the accounts that we use, make sure you check out this video next. And thank you for CDIC for working with us on this video. And if you have any questions about CDIC, ask away in the comments and check out their website.